Welcome to the Consumer Financial Protection Bureau's public meeting of its Consumer Advisory Board, or the CAB, as we like to call it, at the CenturyLink Convention Center in Omaha, Nebraska. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Zixta Martinez. I am the Associate Director for External Affairs at the CFPB. Our public audience today includes consumer advocates, industry representatives, state and local officials, and of course, consumers. We are especially pleased to have in the audience Mark Quandal, the Director of Nebraska's Department of Banking and Finance, as well as staff from Nebraska's Attorney General, Doug Peterson. We're delighted that you are all here. Let me spend just a few minutes telling you about what you can expect at today's meeting. First, I'll introduce the Bureau's CAB members. Then the CFPB's Director, Richard Cordray, will provide opening remarks. Following the Director's remarks, Kelly Cochran, the Bureau's Assistant Director for the Office of Regulations, will engage the CAB in a panel discussion about the CFPB's Small Business Regulatory Enforcement Fairness Act proposals on small dollar lending. After the small dollar lending discussion with the CAB, there will be an opportunity to hear from members of the public. The public meeting will adjourn at approximately 12:30 p.m. and resume at 2:30 p.m. When the meeting resumes at 2:30 p.m., CAB members Ann Bador, Julie Guggen, and Jean Spencer will discuss trends and themes in the field. The public meeting will then adjourn at approximately 4:00 p.m. As many of you may know, the Dodd-Frank Wall Street Reform and Consumer Protection Act, which created the CFPB, also provided for the establishment of the CFPB's Consumer Advisory Board to advise and consult with the CFPB in the exercise of its functions and to provide information on emerging practices in consumer financial products or services industry, including regional trends, concerns, and other relevant information. Today's public meeting and discussion is in support of this statutory responsibility. As a reminder, the views of the CAB are their views, and they are greatly appreciated. However, they do not represent the views of the CFPB. Today's public meeting is being recorded and will be available at consumerfinance.gov. You can also follow CFPB on Twitter and Facebook. So let's get started with an introduction of our CAB members. The chair is Bill Bynum. Bill is the CEO of Hope Enterprise Corporation in Jackson, Mississippi. The vice chair is Mava Elise Brown. Mava is Executive Director of Housing and Economic Rights Advocates in Oakland, California. Gary Acosta is the CEO and co-founder of the National Association of Hispanic Real Estate Professionals in San Diego, California. Ann Bador is the director of the Fair Financial Services Program at Texas Appleseed in Austin, Texas. Joanne Barefoot is CEO of Joanne Barefoot Group in Washington, D.C. Don Baylor is a senior associate at the Urban Institute in Washington, D.C. Steve Carlson is the co-founder and CEO of Ascend Consumer Finance in Mountain View, California. Laura Castro de Cortez is the Director of Business Product Development for Meta Payment Systems in Omaha, Nebraska. Elizabeth Kossel is a Senior Advisor for Consumer Protection at the AARP Public Policy Institute in Washington, D.C. Prentice Cox is an Associate Professor of Law at the University of Minnesota in Minneapolis, Minnesota. Patricia Garcia Duarte is the President and CEO of Neighborhood Housing Services of Phoenix in Phoenix, Arizona. Julie Guggen is the Executive Director for the Minnesota Homeownership Center in St. Paul, Minnesota. Patty Hassan is the president of Clarify in Philadelphia, Pennsylvania. Brian Long is the CEO at Wolters Kluwer Financial and Compliance Services in Minneapolis, Minnesota. Jennifer Majuri is the executive director for the Young Invincibles in Washington, D.C. Joanne Needleman is senior counsel at Clark Hills Consumer Financial Services Regulatory and Compliance Group in Philadelphia, Pennsylvania. Patrick O'Shaughnessy is the president and CEO of Advance America, Inc. in Spartanburg, South Carolina. Dory Rand is the president of the Woodstock Institute in Chicago, Illinois. Ellen Seidman is a senior fellow at the Urban Institute in Washington, D.C. Jean Spencer is the senior vice president for stakeholder engagement, policy, and research for the Homeownership Preservation Foundation in Minneapolis, Minnesota. Robert Stoll is the founder of Stoll Byrne LLC in Portland, Oregon. Jim Van Dyke is the founder and CEO of Javelin Strategy and Research LLC, a division of Greenwich Associates in Pleasanton, California. We also have with us Delicia Hand, CFPB Staff Director for the Bureau's Advisory Board and Councils. I'm now pleased to introduce Richard Cordray, who will provide opening remarks. He will be followed by CAB Chair Bill Bynum. Prior to Richard Cordray's current role as the CFPB's first director, he led the CFPB's enforcement office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Zixta, and I would like to thank the community here in Omaha for hosting us so warmly, especially the hometown member of our Consumer Advisory Board, Laura Castro de Cortez, who had been urging us to get to Omaha for quite some time. Yes. And as you can see, she's very persuasive. For myself, this is my first trip to the Cornhusker State, though I do recall fondly a conversation I had with former Senator Johans a few years ago where we talked about welcoming Nebraska to the Big Ten, having grown up myself in Columbus, Ohio. When we travel outside Washington, D.C., as we are today, I always appreciate the opportunity to meet with members of the community to learn about the concerns of consumers and providers in different parts of the country. Often they have the same things to say as people in other parts of the country, but often they say it differently, and sometimes there are nuances and texture that really help illustrate different concerns. We always look forward to our dialogue with the Consumer Advisory Board members as their perspectives offer us greater insight and expertise, which helps us improve how consumer financial markets work for the American consumer, and that has been true again in our meetings yesterday and today. Our advisory board is a group of diverse representatives who are charged with helping us to identify, among other things, the key issues cropping up all over the country, especially in places where our daily work might not otherwise take us. They present us with diverse viewpoints and thereby sharpen our approach to consumer financial protection. We're especially pleased today to have the opportunity to hear from our advisory board members on the topic of small dollar lending, which we understand to encompass payday, auto title, and other installment lending. This important subject has been the topic of continued interest to our board members, and we're glad to have their insights and expertise to help us build out on the many stakeholder perspectives we're receiving on these issues right now. Earlier this year, we took an important step toward addressing some of the problems that we perceive in the short-term and longer-term small dollar credit markets. In March of this year, we released an outline of proposals that we're considering in connection with regulating payday loans, auto title loans, and certain longer-term installment loans. The framework would require lenders to take steps to make sure borrowers actually have the ability to repay their loans without defaulting or repeatedly rolling them over into persistent obligations with repeated fees that constitute so-called debt traps. If adopted, these measures would put in place strong federal rules for these products that would be intended to coexist with stricter state, local, and tribal consumer laws and regulations, which range from prohibiting the sale of such products to regulating the permissible cost of such credit. We initiated this discussion as part of a process our statutes require us to follow as the first step toward adopting regulations, starting with feedback we received from small businesses and all other affected stakeholders, including consumers, providers, and state and tribal governments. And we have received exactly the kind of thoughtful feedback that we expected over the past few months. Today, we'll discuss some of the themes that have emerged over this period while obtaining further input from our Consumer Advisory Board. This formal and deliberative process will lead to fundamental decisions about the proper direction of reform in this important marketplace for consumers. The proposals we released earlier this year were developed after much study and analysis conducted over the past 3 years. We've engaged in intensive analysis of the short-term and longer-term credit markets for personal loans, and we produced the most comprehensive studies to date on the short-term small dollar loan market. We've also focused carefully on how consumers are affected by the kinds of credit products that have evolved to meet this demand. These studies and inquiries confirm that payday loans, while designed for short-term use, lead many consumers into longer-term expensive burdens. For too many consumers, as we saw from our study and analysis of many millions of loans, payday loans and other small dollar credit products are debt traps. The stress of having to return every 2 weeks to reborrow the same dollars after paying repeated exorbitant fees and interest charges can become an oppressive constraint on the consumer's financial freedom. Some have claimed that low numbers of complaints about payday and other small dollar credit products demonstrate that consumers do not have concerns about these products. This is inaccurate and misleading. In our Consumer Response Annual Report for 2014, we noted how frequently consumers submitted debt collection complaints to the Bureau that were related to their payday loans. In addition to the 5,600 payday loan complaints handled during 2014, the CFPB also handled 12,400 debt collection complaints that stemmed from payday loans, which account for nearly 14% of all debt collection complaints that we handled in 2014. Through the first 5 months of this year as well, the Bureau has received approximately 2,400 payday loan complaints and 3,900 payday loan-related debt collection complaints. So in total, the Bureau has received over 24,000 consumer complaints related to payday loans in less than a year and a half. Clearly, consumers continue to encounter problems and express concerns with these products. So as we continue to engage in further study and analysis and to absorb and digest extensive feedback, we remain determined to take the important step of adopting new regulations to address consumer harm in both the short-term and longer-term small dollar credit markets. We believe the measures we are considering could dramatically improve outcomes in these markets while preserving access to responsible credit for consumers who clearly have a demand for it. Consumers would still be able to get the credit they need, but they would do so within a framework of stronger consumer protections under federal and state law. We've approached today's public conversation as an occasion to reiterate how important it is to ensure that consumers have access to safe products and that their interests are protected when they use these products. We will first hear from my colleague Kelly Cochran about the feedback we've received to date on a proposed framework for regulating small dollar loans. Then we'll hear a discussion that includes members of our advisory board on trends they're seeing out in the field. Among other interesting topics, we'll discuss implications for underwriting small dollar credit products and what information is available about take-up rates for alternative lending programs. What we hear today from the interchange between our advisory board members and our colleagues, as well as from the public testimony, will help us improve our work. So we thank you all for being here today, and we look forward to a robust discussion. Thank you.
Thank you, Director Cordray. Good morning. I want to begin by echoing the Director's comments about how much we as a board appreciate being here in Omaha. I want to thank our colleague Laura for making us feel so welcome, and also to the Bureau for providing the board an opportunity to get into communities and to engage with consumers and experts about these important issues. So we're very glad to be here. Since the Consumer Advisory Board was established in 2012. Both access to safe dollar products, to safe small dollar products, and restrictions on predatory products has been a featured topic of discussion for the CAB. Today marks a very important juncture in the Bureau's work on these topics to date. Earlier this year, the Bureau released an outline for a proposed approach to regulating these small loans. As an advisor group, this is our first formal opportunity as a full board to provide feedback and input to the Bureau on these important topics. And so we look forward to hearing from staff about the themes that have started to emerge and to hearing from our fellow CAB members about their responses to these themes. To get today's discussion started, we have with us Corey Stone, the Assistant Director for the Bureau's Deposits, Liquidity, Lending, and Reporting Markets, and Kelly Cochran, Assistant Director for the Bureau's Office of Regulations. Kelly and Corey will provide us with an overview of the recent proposal and then highlight some emerging themes to which we will provide input. So, Kelly?
Thank you very much. I'll start off with just a brief overview of the outline that we released in March, and then Corey is going to talk a bit about some of the feedback that we've received and start off with some discussion questions. So look forward to the discussion. Let's see. There we go. We'll start actually just by talking a bit about where we are in the process. So the CFPB is considering rulemaking proposals that focus on payday, auto title, and similar installment lending. We're focusing specifically on harms that come from unaffordable loans and on certain collection practices in connection with deriving payments from consumers' accounts. We are continuing to study these markets and a wide variety of practices in these markets, and so it may be that there are additional practices that we will address over time, but these specific outlines are focusing on those two issues, and that's what we'll be focusing on today. As everyone has said, we published the outline of proposals in March as part of the small business review process. That is a process that is an interagency engagement. We work with the Small Business Administration's Office of Advocacy and the Office of Management and Budget. We meet with a number of small lenders of different types who could be potentially affected by the outline of proposals, and spent an entire day, as well as a number of kind of lead-up conversations, talking about the potential impacts, alternatives, and issues that we were seeing in this space. It was an extremely helpful process. We're now in the process of writing up the report, the interagency report from that, and we will publish that at the same time that we publish a proposal, which we expect and hope to release later in the year. That is only one part of the outreach that we are doing right now, and we have been talking to a wide variety of stakeholders in a wide variety of settings, really seeking input and feedback on the outlines. This is something that we do in a number of our rulemakings, and we want to release the outlines at a stage where we've done enough thinking to have a fairly concrete framework for people to react to, because we think it's really helpful to get that response, but we're still thinking through the process for ourselves and trying to very much refine our thinking. So it's a balance to find that perfect timing, and discussions like these are incredibly helpful to us, so we really welcome that. So very briefly, I'll go through an outline of the proposals that we're considering, but since they have been out for 2 months and people have had some time to digest it, don't want to take too much time away from the main discussion. The coverage that we are thinking about includes two categories of loans. The first is short-term loans, which we are thinking of defining as 45 days or less, and it would simply include all loans within that term. We are also thinking of covering some longer-term loans, but there the coverage threshold may be more complicated. In particular, we're thinking that loans would be covered if they meet two separate prongs. The first is that the cost would be an all-in annual percentage rate of 36% or above, and that there would be a second prong, which is either account access for the consumer in terms of payroll access or deposit account access, prepaid access, and so on, or a vehicle title, because we believe that both of those mechanisms may change the dynamics with the consumer and increase the risk of harm to the consumer where the loan goes bad. The proposals would apply broadly to all creditors, regardless of their charter type, whether they're a depository of some type or a non-depository, and also online and storefront. And we are assuming that we would most likely exclude certain categories of loans, such as real estate secured loans, credit cards, overdraft, services, student loans, and most pawn loans. I will note that we are in the process of looking separately in separate proceedings, both at debt collection issues and issues with overdraft services. So those are both items that are on our radar and that we are thinking about, but they're not part of this specific set of discussion for today. The basic proposal includes two elements that we're considering. The first is to ensure that lenders take steps to make sure that the loans are affordable for consumers to pay. And we're thinking that there may be two ways to accomplish this goal. One would be by determining up front that the consumer has the ability to repay the loan without reborrowing or defaulting. Or secondly, that there would be some loans that could be made with a combination of requirements, including both some upfront screening and some back-end protection and structural requirements to make sure that the consumer can repay the loan over time. The second part of the proposal concerns the payment practices that we were discussing and to put certain limitations to make sure that consumers don't lose control of their accounts and end up racking up a lot of fees in the process of the lender trying to collect payment out of those accounts. Very briefly, to discuss the first set of requirements regarding the affordability determinations, the main part of the first prong and the first way of satisfying the proposals that we're considering would be to make an ability to repay determination up front. The basic concept is that lenders would need to obtain and consider some documentation of certain consumer financial information. It would include things like the consumer's income, their specified major financial obligations such as housing, and borrowing history on covered loans, both within the own lender and their affiliates, but also with other lenders through checking with a commercially available reporting system. The lenders would then need to use that information to make a reasonable determination that the consumer has the ability to repay the loan, including both the payments on that loan as well as their other living expenses. And for short-term and balloon products in particular, that focusing on whether they can make the payments without reborrowing within 60 days of the previous loan, because our research indicates that those loans are particularly likely to lead to a cycle of reborrowing. We think it's very important to consider the long-term impacts. We are also considering, in addition to the general underwriting, imposing some presumptions of inability to repay in certain circumstances when a consumer is coming back for a second or third or further loan. The first presumption set of presumptions would apply probably to short-term loans and to longer-term loans that have a balloon payment somewhere in their mix. The lenders would be required to presume that the consumer lacks the ability to repay a covered loan of either of those types if the consumer returns to reborrow within that 60-day period of the previous loan. We're looking at 60 days because it allows us to look at two expense cycles for the consumer to see whether they've really been able to account for the previous loan and stabilize their finances, or whether that previous loan has kind of started to suck them into a deeper financial problem. To rebut the presumption on the second or third loan, we are considering requiring that lenders would need some sort of verified evidence that there's been a change in circumstances that now confirms that the consumer would be able to repay the first loan even though they had problems with the previous. After the third loan in the sequence, we are considering basically a conclusive presumption of inability to repay that would prohibit any further borrowing within a 60-day period. So it's basically a cooling off period to make sure that the consumer has an opportunity to stabilize. We are also considering a presumption that would apply to certain longer-term loans that don't involve balloon payments. And there we would be looking at circumstances where there's a refinancing going on and there's some indication that the consumer is in financial distress. So they're delinquent or in default, there are other problems developing. And again, we would require that the lender obtain verified evidence that indicates that the consumer is going to be able to repay this refinance loan even though they've been having problems with the previous one. We are also, as I mentioned, looking at whether it's possible to provide sufficient protections to consumers through alternative requirements that would combine both some upfront screening as well as some structural protections. We have a number of these that we put on the table for discussion because we wanted to get feedback from people about whether they were workable or not, whether they were both protective of consumers and might provide some advantages to lenders as well in terms of compliance burden. I'll talk first about the short-term alternatives that we're thinking about and about the long-term ones. There's some alternatives that we're thinking in each case, so we're seeking feedback on a number of items. First, with the short-term loan requirements, there would be some screening in terms of verifying the consumer's income, and again, determining that the consumer is not already in a cycle of debt by checking to see what their prior lending history has been, whether they have covered loans outstanding. And then on top of that, we would impose certain structural conditions on the loan in terms of limiting the maximum principal, the duration of the loan, and in particular, putting on a tapering off mechanism to make sure that the consumer could repay the loan over time. So basically, it would allow the consumer to take up to 3 loans within the 60-day cycle, but then make sure that they would have an off-ramp at the end. And we're considering 2 options that we would really appreciate feedback on. One is that after the 3rd loan in the sequence, there would be an off-ramp or workout period if the consumer is in distress and hasn't been able to repay the loan, to allow them to pay it back over time. The second would be a structure that would actually decrease in steps each of the 3 loans so that the consumer is weaning themselves off kind of step by step. It's almost an amortization structure, but in separate loans over time. On the long-term side, we are also looking at 2 alternatives. One of them is built on a set of principles that the National Credit Union Administration has embodied in its payday alternative loan program, and another looks at payment to income ratios. Both of them would require basic screening. So again, verifying the consumer income, making sure that the consumer is not already in a cycle of debt, determining how many loans they've had within a specified rolling period. The structural conditions piece would be different depending on the alternative. So the NCUA payday alternative loan program model would put some limits on the size, the structure of the loan, but would also put some limits on costs, so there would be no more than 28% interest and $20 per application fee. The maximum PTI structure would limit the payment so that it's no more than 5% of the consumer's expected gross income during the same period, and then again would have some structural protections in terms of how the loan's structured. So we're seeking feedback, and Corey will talk a bit about what feedback we've gained so far on those options. Then we'll just spend a minute on the payment collection practices. As I said, there are 2 items that we're considering there. The first is that the lenders would be required to provide a notice to the consumer before attempting to withdraw the payment from their account. We were thinking a 3-day notice with basic information about the payment channel that's going to be used, the amount of money, how that money would be allocated as between principal and other expenses, just basic information so that the consumer knows it's coming and can take steps to make sure that the money is there and available to make it work smoothly, or can contact the lender if there's some concern or dispute over the account. The second is to limit the number of attempts to pull money out of the account on the back end where there has been some problem. This can be a large source of fees to the consumer, both from their bank and from the lender, and can really exacerbate the problems and lead to the consumer kind of losing control of the account. So our proposal that we are thinking about is that after 2 consecutive unsuccessful attempts to withdraw payment from the account, the lender would be prohibited from making a 3rd attempt until they go back to the consumer and get reauthorization. And this would apply across different channels, so not just repeated ACH, but also if they were using remotely created checks or a variety of methods. If 2 in a row bounce, that would be the break to make sure that the consumer and the lender have a chance to talk and kind of reset. So that's a brief overview. We're happy to answer questions during the discussion, but want to make sure that we save time. So I'll turn this over to Corey.
Great. I will need that. Yeah, thank you.
Thank you, Kelly, and good morning. As Kelly said, the SBREFA process gives us an opportunity to share aspects of a potential rulemaking that we're considering in advance of an actual proposal. The formal part of the process is to hear from small enterprises affected, but it gives us an opportunity also to hear from other stakeholders. So we have heard from large businesses as well as small. We've heard from consumer advocates, other regulators, and other financial institutions who are not necessarily in the small dollar space, but are considering being in it, and whose opinion we value. So what I'm going to share a little bit is some of the feedback that we've heard, as well as some of the questions that raises. The first generally has to do with the assessment of affordability and how these small dollar loans under a rule would get underwritten. We've heard some responses to the very specific requirements of the rule that require verification of income, verification of housing expenses, and other financial obligations. Some have said that, in fact, most lenders do verify income and that other kinds of expense or obligation verification practices vary quite widely today, but there is quite a bit of underwriting happening. Another thing we've heard is that in response to the requirement that part of the affordability assessment be checking a commercially available database that would identify whether a consumer has another covered loan, that there actually are consumer reporting agencies that are active and serving this market today that have the capability to fill that need, not without some investment and not without some changes in the makeup of firms and competitive structure, but they wouldn't be starting from scratch. I think a third general piece of feedback is that there is a general concern about the interaction between a federal rule and state regulations that cover short-term loans, both and longer-term loans that would be covered under our rule, where there would have to be some adjustment at the state level to accommodate loans that would be permitted under our rule and underwriting practices permitted under our rule. So kind of a first question to pose to members of the CAB is, what are the alternatives, given some of the responses that we've had to feedback that income verification using documents like pay stubs or account statements can be expensive or time-consuming, that it's old tech and not necessarily benefiting from automation, or that these documents could be forged. What are the alternatives that the Bureau should be considering for verification of income? Sorry, go ahead.
Steve?
Yes, I could, I probably can and want to opine on every question here, so I'm going to try and figure out how to work through it, but I'll go first. So just a little bit of background. I run an online lending service today. We're in our infancy and we're working through this. I will say that we have not found very strong alternative sources today outside of actually verifying income with pay stubs or bank statements. There are alternatives in the market. They don't have a broad coverage typically, and there's questions about their accuracy. So when I look at this first question, or the first two questions on this bullet point, I would say a few things. One is, I think pay stubs and bank account statements are probably the standard in today's market. I do think that I know that there's alternatives out there that people are working hard on. I would encourage, there's a lot of focus here around documents and collecting documents and storing documents. So I'd encourage that any end rule is not based on 2015 standards, but takes into account that in 3, 5, 10 years, somebody's going to figure out a way to verify income with a much greater degree of accuracy that will be electronic, and we should be able to support that. The second piece here is around fraudulent documents, and I would say that that's, at least from an online perspective, that's a significant concern. I don't know how you address it. That's the consumer providing that to the lender, and it's up to the lender to do everything they can to make sure that it's accurate, but it's a risk of business.
I think we had another. I'll expand the question a bit because some of the same issues come around verification of housing expenses, which is one of the requirements. We've heard some feedback that it's difficult to do in the case of rent generally, unless the consumer has a lease available, but also some consumers are sharing rent and may not be the signer of the lease. Some consumers are living at home or with parents or with relatives or have less formal housing arrangements. Any feedback on housing expense verification?
Will you be able to take multiple, because you see that in a lot of Hispanic homes where several people are contributing. Will you be able to do that where people can submit, because there'll be even 4, even 5 sometimes, where they're all contributing and they make the payments just fine, thank you very much, but you'll be able to leave that even in the application form?
That's a question that we're trying to figure out how to do. We recognize that there are quite a few people who contribute to housing expense, but they might not be the name of the person who's on the lease. And so the question would be how to verify that when a person is saying that they are contributing to rent, but where there's no formal documentation of that.
Well, I find most of the time it's usually through money orders. They're all, pitching in money orders, which is, how do you go and, make copies of who is getting the receipt for the money orders, for the amount. It'll be money orders, they're withdrawing cash or they're cashing checks, loading them up to their reloadable cards. So there's other ways of verifying other than a checking account.
Great. Thank you. A broader way to ask this question is, are there any circumstances where a consumer's stated income or stated expenses should be acceptable as a assessment, as part of an assessment of ability to repay, or should we always be requiring documentation of the situations where we shouldn't need to?
I think particularly on the income, I would also make an argument for the expenses because the industry standard right now is to more or less verify income. So I wouldn't see a reason why we'd want to put in a rule that would actually kind of take us backward in terms of underwriting. And I would also make the argument that the bank statement, I think, is potentially a way to kind of cross-check what is happening on the pay stubs as well. Because it's not going to be universal that you're going to see pay as well as housing expenses and other major financial obligations kind of come through on the bank account statement. I think I would also make the argument, or just kind of throw it out there for discussion, that there's been a lot of discussion around income volatility. And to the extent that we are only looking at one pay cycle or 1 month, we should just recognize that that is kind of a hole in our data understanding if kind of the consensus is that, particularly for this population, they are experiencing a lot of income volatility month to month.
Great. Thanks, Don. And that's a good segue into kind of some feedback that we've received about the availability of consumers' bank account information. As more and more payments are electronic, we understand that a bank account statement can contain more and more information about a consumer's expenses as well as just their deposits and items out. And there are now a number of lenders and service providers who are saying, respectively, that they can use and provide electronic access to a consumer's checking account information through services that, with the consumer's consent, by providing a username and password, essentially go online to the consumer's financial institution and get that information. That raises some security concerns, but should we be encouraging lenders to access information in that way and use it as part of underwriting? Potential source of automation, potential security exposure to the consumer.
So I just have, some general comments about the questions overall. So I do believe that this is going to be an issue that is going to be increasingly relevant to the whole topic of lending moving forward. It is really important for immigrant populations, Hispanic populations, but even today, the younger populations, the so-called millennials, they earn income in very different ways, as a whole, than I think their predecessors did. I know I have one boomerang millennial living in my house right now, and she does websites, and she drives for Uber, and all those are the way people are making income today, very non-traditional. Ironically, when you kind of pre-crash, I was never an advocate for stated income loans in the mortgage sector, even during that period of time when it was so widely used, because it was clear that there were abuses taking place in the marketplace. Post-crash, I think, ironically, I'm sort of trying to figure out, I'm kind of drifting back the other way, because there's no question that there are people who have the means and the capacity to be successful borrowers that are no longer getting access to credit, and therefore are going through alternative means that I think are even worse for them. So I think, to Steve's point, there's people addressing this right now. Just like credit scoring kind of changed the way we look at credit reports, I think there's going to be innovations on how we can look at capacity, income capacity, the ability to repay in a more holistic sense than just purely what income is there. I do know that, so my comment to stated income, if someone's stating an income that is within a reasonable band for the job that they serve, and I think there's data on that on websites like salary.com and so forth, those are things and resources we used years ago in the mortgage space that I think are even better today, then maybe that should be a possibility, especially for a smaller dollar amount. Someone says that they're making $3,000 a month as a masonry, that's probably a reasonable, income to assume. Someone says they're making $30,000 a month delivering pizzas, that's probably not reasonable. And those are extreme examples, but I do think that there should be some way that we can make this process a little bit more relevant and a little easier for consumers that are on the margin. And that's really what we're talking about here.
Gene.
Oh, yeah. Thank you. Yeah, let me swing over to the expense side for a second, because the Homeownership Preservation Foundation operate a nationwide network of housing counselors that are primarily focused these days on helping people sustain modifications and getting to what is their actual the expense side of the equation is really challenging. And oftentimes people, when they provide their estimates, they're based on their perceptions, but until you actually work with them to go through and get back into the details, it's only then do you get a more realistic picture of what the expense side is. Oftentimes it requires reverse engineering. You say, okay, you've given us, this is your income, this is your expense, but you say you're running a deficit of X, so something is not appropriate in this equation. And so, building the so having people who can actually spend the time to work with the client to get to a more realistic number has proven to be very beneficial in helping people on the housing side to sustain modifications and to have a realistic spending plan. So that may be applicable in this space.
I have a lot of concerns about this stated income, and especially because these are tend to be smaller dollar loans that I think it opens up a lot of opportunity for abuse and people being perhaps encouraged to assert a particular income that may not be realistically reflective of what their income is. And I think what Don said is that right now the standard in the market generally is to look at pay stubs. And so it doesn't seem like it's a stretch or a burden to have that be part of the requirement. And I think that there will be a lot of evolving technology to streamline and help make these processes more efficient. I'm also concerned about standardizing or encouraging people passing on their passwords and letting the lender access that. I mean, we've had some problems, not very recently, but over the past 7 years in Texas, where particular small dollar lenders had disposed of people's personal information in a dumpster and led to a lot of identity theft concerns. And so I think that that's very private information where even if there's not intentional abuse, could really put people already in a vulnerable circumstance in a more vulnerable one.
Lori? Oh, I'm sorry.
Bill, can I just follow on that real quick? I think in the student lending space, we tell people not to give their PINs out when they're working with counselors around their student loan debt. So I don't know why we would encourage people to give anybody their access to their bank account. So I echo Ann's comments.
I just want to reinforce the point that some people have made about the need to have a regulation that on one level can be very sort of simple to implement for the lender and clear cut, that you know you're inside the lines, and yet still allow for innovation and more sophisticated processes. I know there are some large banks that are interested in offering this product and want to be able to run it through what they think is going to be a very sophisticated and accurate risk system that's going to be looking at sort of big data kinds of and alternative data, and can keep the cost low at the same time. So it's hard. It's a hard challenge for you, but to be able to make both of those scenarios work, I think, is really important. And this income volatility issue is one of the critical things that I think we're all learning. I'm on the board of the Center for Financial Services Innovation. We've done a lot of research, as has the CFPB, realizing that a lot of that the consumers we're talking about here, the ones that we want to be able to get a small dollar loan, because they have the ability to repay, are generally people who have enough money to pay back their loan, but they may not have it at the right moment. So they have a volatility problem, a liquidity problem rather than a basic income problem. And so there's a lot of innovation going on with people thinking about these smoothing kinds of alternative products that would let people either through their employer or on their own be able to, borrow ahead and then save easily with the product, or borrow for the money that they've already earned with their employer and get it into their hands at the moment where they need it. So making sure that the regulation allows for a lot of that to emerge, I think, is critical.
Great.
Maybe, yes.
Just, I want, on the stated income issue, I share the sense from the mortgage market of folks who work in that space of being very concerned that it's going to be, that people who are not realizing that they're setting themselves up for trouble, even by putting down a suggested number, are going to get sucked into a worse morass than they may already be in. And particularly for people who have even less that they can afford to lose than other folks. I think that's a horrendous road to walk down. And one of the things that we've also talked about is that not everybody who may need money will be able to successfully run the gauntlet of this rule, and that's okay. In my feeling, that's okay. Got to have some basic rules, minimum standards to try to protect people.
So I think Joanne and Gary both got to kind of the broader question of kind of moving from a kind of mathematics-based assessment of ability to pay, income minus expenses leaves residual income, and is there enough to cover the costs of the loan, where expenses include existing debt obligations. Moving from that to more of a probabilistic approach where you're looking at characteristics of the consumer from credit report and other kind of data and making a judgment that can be more or less accurate, but won't be foolproof about the probability of being able to repay and to repay without reborrowing. Today, there aren't
mechanisms that exist, at least from the feedback that we've received in the market, that predict ability to repay without reborrowing. Most underwriting happens to prevent fraud and first payment defaults, the people who don't intend to repay but not ability. But is there, in anybody's judgment, an automation solution here based on more automated approaches to underwriting without going through the math as we've been considering it?
I would say, in terms of the predictive model, first you got to break it out, the shorter term, small dollar piece, and then with the longer term, because with the longer term, if the way I understand it is there is no cap in terms of length, and there are loans in that space that are, 1, 2, 3, 4, 5 years in length, and you can't do a loan like that without having predictive underwriting in place, or at least I would highly recommend no lender does a loan like that. On the shorter term piece, my understanding is the reason that it really is not done today is because there is no centralized database around people's loan performance history with shorter term dollars. It tends to be stuck all at each of the individual lenders. And everything that's pointing here is they're going to have to go towards a centralized database model. All of a sudden that data is going to exist and people are going to start using it from a predictive standpoint. And I don't know why you wouldn't want to help encourage that if it's the lenders as well as the consumer's best interest to better understand the ability to repay a loan.
Great.
Gene?
Yeah, I would agree that having predictive models would be, very helpful. But I think that's a ways off, and still using the residual income concept to help increase the visibility into the capacity of an individual, to be able to pay this, is still an important element. It certainly helps the individual. I think it provides greater help to the individual than just a score number, which is, kind of a black box driven index. But, it helps taking someone through the whole process of residual income really helps them understand what am I doing? What am I spending money on? How can I adjust that to give myself greater capacity, not only to repay this loan, but actually to move outside of having to depend on these types of loans.
Betsy?
I agree with Gene. I think we have to get away from the idea that everybody who walks in and says they need this loan should get it. Because I think if they truly can't afford it, they're worse off with the loan than they would have been without it. And therefore, I'm not opining on exactly how we should get the ability to repay, but I think that should be the underlying objective of the regulation. And this will help the borrowers too, because it may take a little longer, they may think twice, they will have to produce some things that would show that they actually have residual income to pay the loan. This can well be an educational process for them, so that maybe even before they get the loan, they have to figure out how they can change how they use their money, and maybe avoid certainly getting into a debt trap with such a loan.
At Clarify, when people come to us in financial distress, both whether it's credit counseling where they have to produce a budget with us and we have to show creditors that they have the ability to repay through a debt management plan, and loan modifications where, again, we have to go through a full budget, we show the creditors that they have the ability to pay the loan modification. I guess I'm thinking it's kind of ironic to pay back creditors, we've got to go through all of those standards. But up front, we're kind of saying, don't worry about it. It's not important. So just something to think about.
As a credit union that makes a lot of loans to some of the consumers that we're discussing, I think a reliable, predictive model would be extremely welcome. But there are a lot of gaps in data, particularly with regard to lower income, underbanked, and unbanked consumers. I know we're talking about more often consumers who have a banking account, but for example, when we make a loan, we often don't know until we start to experience overdrafts when payday lenders start to make multiple withdrawals from an account that a borrower even had a payday loan because they don't report to the bureaus. So I think some of the recommendations about requiring reporting to a widely accessible bureau is extremely important as well.
Great. Thank you. I thought maybe we should move on and talk about the questions that we have about the alternatives that Kelly described. These are alternatives to the affordability assessment requirement. And as you remember, she talked about both an alternative to the short-term loan requirement and a couple of alternatives to the long-term. On the short-term, remember, there is the alternative where a consumer could borrow up to 3 short-term loans within a 60-day period, but at that point, they would have to move into some kind of off-ramp, either having had the loan amortized up to that point, or a set of payments that have no finance charges over a number of periods to permit them to repay in small chunks. We've heard feedback on both sides of the board that we shouldn't be relaxing the requirement to assess ability to repay at all. On the other side, that the alternative is too short, that it's restrictive and doesn't meet the needs of consumers. So leads us to consider the question, should we be providing that kind of exception to the underwriting requirements for the short-term loans, even with the structural protections of 3 and done?
I think this is a really key part of the rulemaking decision, so I promise not to be brief, but I will try to be articulate. I think the answer to your question is no and yes. I don't think there should be an exception to the underwriting requirement, but I think there is. I think the percentage of payment to income is a shorthand substitute for underwriting. And in order to answer that, why should that be allowed? I think you have to identify what the problem is and what the tools you have and what you're trying to achieve. And the shortest way I can summarize the debt trap problem is the analogy to equity-based lending in real estate. We don't allow that, and it has horrible consequences because we don't underwrite. And that's because the alternative is that people are getting loans that result in catastrophic. This is the same essential problem we have here, which is people are pledging all their income, and then when it comes time to repay, they don't have any alternatives because they provided direct preferred repayment access to their accounts that allows someone to take all their income, and they're given no alternatives. It's similar type of problem. The second question then is, what are the tools? The tools here are a little different. You have what is the type of regulatory problem, and tool here is different than some of the other problems the CFPB is facing. And I would say this is a really complicated rulemaking process and problem. And the staff has done an amazing job of articulating alternatives and studying this, and the CFPB has been extremely thoughtful about collecting input to make a good decision here. The best way for me to articulate why this is the type of problem this is, it's the opposite of what I think the arbitration problem is. I perceive the arbitration issue as one of people who have power, using that power to completely realign the balance of power between the consumer and the seller so that the consumer is deprived of all their rights. And to me, this is not a difficult regulatory problem, particularly given the express authority to deal with arbitration. This problem is different. We're dealing with the general UDAP authority of the CFPB, and we're dealing with a regulatory problem that presents really in a classic way that credit access versus consumer protection sorts of issues. And in that situation, I think that what we're trying to do is with the CFPB rule is different than the question if you were before a state legislature of whether this lending is socially beneficial as a whole or not. Some states have said no. Some states have put no restrictions. And it's really important that states be allowed to continue to make those different decisions, as you articulated before. But the CFPB is setting a floor that prevents unfair and deceptive and abusive acts and practices. And in that situation, I think some sort of percentage of payment monthly to monthly income is a solution that attacks the core of the problem by providing a substitute form, shorthand form for underwriting, when it's combined with some limits on the duration of this preferred repayment access device, which is the nub of the problem, and some proration of the fees. It provides a balanced approach which sets a floor that takes care of the core problem that's being addressed in a way that I think is clearly within the authority of the agency to do. And thank you for letting me run on.
So with very great respect for Prentice, I have to strongly disagree that the 5% PTI is a suitable short-term substitute for real ability to repay based on income and expenses and residual income. And I'll give you an example from my experience in Chicago several years ago. I was contacted by a gentleman who was a client of AIDS Legal Counsel. He was on SSI disability payments as his only source of income. He was a longtime customer of a major bank that was changing their policies on charging monthly maintenance fees, raising fees to $10 or $12 a month. Based on his income and very high housing costs and other costs, he could not afford even $10 or $12 a month bank fee. That's significantly less than what a 5% PTI would be for him. And I don't want to see people like him get sucked into payday loans that they can't repay based on a 5% PTI. And I know that many, many of my consumer advocate colleagues around the country very much agree that the 5% PTI is not a suitable alternative for real ability to repay standards.
So I want to go a little somewhere else on the issue of the cooling off period and the step down. I think we've heard a number of people talk about the issues all the way through here about not knowing about outstanding loans. And that has all kinds of consequences, both with respect to an individual standing in front of you that you don't actually know what else they have out there, and in terms of developing effective models and predictors. And so I think that, and then if you look at the step down and the cooling off period, the problem of how you figure out whether somebody has had two loans, if they're not from you, both from you, or whether they've in fact cooled off for 60 days. The critical piece that's missing to me is the National Registry. I think there probably is a commercial opportunity there, but I also think that this is a place where the CFPB, with its national jurisdiction, may have an ability to make enormous impact that then the states could build on. So building on Prentice's idea that we're really talking about a floor here, a floor plus information may be a really more effective way for the CFPB to make a long-term impact in this space that continues to allow the innovation to make for better underwriting.
Just real quick, I just want to say that while it's certainly not perfect, I agree with Prentice about the, which doesn't happen that often, does it really?
No. I think second time. If Josh was here, it would be really fun if he was here.
I think there's a lot to be said for the simplicity of that. And as you say, as we trade off the access and protection issues, they're really tough, but I'm a vote for that.
So I want to piggyback on Ellen's point for a second and make another point. So I understand the issue, obviously, of not, obviously, the Bureau itself creating a national database or registry, but I do believe that this rule should include some trigger mechanism to make such a commercial opportunity actually happen in the marketplace. So to the degree that there can be some language or some direction or some incentive built into the rule to actually encourage this and provide some at least framework about how it may operate, I think that would be immensely helpful. The second point I want to make is in terms of the underwriting, if we're moving towards a twin pillar of pay stubs or in some account and monthly account information being kind of the core ways that underwriting happens, we do have to recognize that auto title does operate a little bit differently in terms of consumers actually having bank accounts. Or other types of accounts for which you can actually get some type of monthly information. So it's just something to kind of consider when we're trying to regulate auto title as well.
Great. Don, thank you for bringing up sorry.
I just want to remind everybody that it shouldn't be so cumbersome that we keep financial institutions from doing these loans, because I think what we always kind of forget to remind people is that most credit unions and banks do not do these small dollar loans. Therefore, that opens up the gates to other financial providers to do these loans. So, I always want to remind people, most credit unions and banks do not service this population. And that is why we are where we are. In Omaha, I don't believe there is one single bank or credit union that does these small dollar loans to unbanked and underbanked. So, just reminding you.
Can I comment on that real quick? I just want to reinforce that, and I think one of the crucial things in this is to try to bring providers into this market as much as we can to encourage competition. The more we have that, the more we're going to have probably better products and better pricing. And for financial institutions, I think that it's really critical. I've talked to a lot of them. Some are not very interested in this product, but some are. They're either interested in it because they feel this is a customer base that they should serve, and they want to have good ways to do it. There are some who are interested in it because they sort of want to be doing the right thing from a reputation and positioning standpoint. There are some who wish they could get Community Reinvestment Act credit if they would do some of this blending. There are some who are doing it because their checking accounts, in light of the recent reform of checking account fees, they have a lot of checking accounts that are money losers, so they're just holding these checking accounts and losing money on them, and they are interested in the potential for adding another product into that customer relationship that could be a profitable product for them. And so they're all kind of all over the map. And one thing I think is really critical is that as this proceeds and you try to position it for financial institutions, it's going to be very important to coordinate with the prudential bank regulators to be sure that everybody's on the same page, and that if a bank offers or a credit union offers these kinds of products, their primary regulators will agree that it's a good product. The other thing that's going on with the banks is that they are offering, and the credit unions, they're offering overdraft services, and so there's, and you all have a sequential regulatory process, so you're going to take up overdraft later in the year, probably late this year, and depending on what that ends up looking like, there are probably going to be a lot of financial institutions that will want to think about whether there's a lending alternative for their customers who now are using the overdraft product. And so that effort at a holistic approach for the type of consumer rather than for the product channel in the bank is a really critical thing. So I hope that whatever comes out of this works for banks.
I think the fact that many banks and credit unions are not serving low-income, underbanked markets is certainly a problem, but it can't be justification for allowing abusive predatory practices. I really applaud the direction that the Bureau's gone. I think the ability to repay rule is the strongest and best solution. It certainly is complex, and it's a long way from being perfect, but it is certainly better than the abuses that many of the people, again, who come into my credit union experience. We all have heard the story about the person who come in for whose car is broken down and need have gotten a payday loan to fix it, and then time comes for that loan to be repaid, and they can't afford to repay it. They go get another, and then another, and another, and we've got many cases, and I've talked about a recent example of a borrower who, after 8 payday loans, owed over $2,100 and was only making, in a month, and was only making $2,000. Certainly during some point in that process, one of the lenders should have known that that borrower did not have the ability to repay. I think those are the kinds of circumstances that we've got to protect people against.
Well, this discussion's a good segue into one of the longer-term alternatives, which was, that Kelly described, which was allowing for loans to be made that are similar to those allowed under the National Credit Union Administration's Payday Alternative Loan Program, and that's a program that allows a loan to be made with a 28% interest rate, and a origination or application fee of $20. The loan has to be a multiple payment loan. It can't be a balloon loan, so it's payment over multiple payments. We've heard, first we know in the market that fewer than 100 credit unions are actually offering loans under those programs. We know there are a number of financial institutions that offer loans at a comparable interest rate, but with higher origination fees. Sometimes those loans involve auto pay, and so would be covered, or sometimes they would be secured against a vehicle that would be added collateral that would qualify a consumer with a low credit score for that loan. But we haven't, we're trying to find out what the right balance is and what would be the right window, if you will, to provide a financial institution the economic viability revenue from the loan to pay for the upfront underwriting and cover what's likely to be, for this group of consumers, additional risk. We really like thoughts on that so we can get this piece right, or if we should basically stick with the constraints that we've got and drop this type of alternative altogether. But that's one of the things that we're talking with financial institutions about and with their regulators.
I just have a question. This part of the proposal confuses me. Maybe I'm just dense, which is probably the case. The reason it confuses me is because and the longer-term piece, it's if you're above 36% APR, right? So you're saying, hey, if you have an alternative, if you follow the NCUA type loans, that's 28% APR, right? Why wouldn't you just go 35% APR? And then you're just not covered at all. Like, what's the incentive to do the 28%?
The NCUA cost structure with 28% plus the application fee actually gets you above 36% all-in APR for loans in that zone. It's about 6 months. It's maximum 6-month product.
That's why
So
it's
it's actually
6.
slightly higher than the overall threshold that we're thinking about.
Yeah.
But as Corey said, we're getting a lot of feedback from people talking about application fees and the fact that if you're doing underwriting, you have real costs that you need to cover, and many consumers aren't getting approved. So, that really does put an economic strain on lenders as they're trying to do the underwriting process. And so that's the piece that we're really starting to focus on.
An important piece of feedback that we've gotten for people who have stringent underwriting standards is that your cost of underwriting every good loan has to include the cost of underwriting the loans that you turn down. So your costs are not just, for example, the credit report that you bought on the loan that you approved, but the two that you bought on the two that you turned down.
Well, and I'll say, as we talk about having to verify all sorts of expenses and everything else, those costs are only going to get higher than they are today. I mean, it's not a cheap proposal the way it's laid out.
Just to be clear, the exception that we've outlined contemplates not eliminating an affordability assessment requirement, but not holding the lender to precisely the verified income, verified expenses, and they would have to check the database, but they wouldn't necessarily have to go through all of the steps that we're requiring in the base rule.
I think there's a halfway or 1/10 way to incorporate this without making it the general rule. There are enforceability issues with all of these exceptions to the end. There's enforceability issues with the ability to repay, as we've discussed. There's much even more complicated would be the enforceability issues with the exceptions to that. And to the extent an exception occurs by a supervised depository institution, you're in a really different place than if you create that rule and the CFPB and states have to enforce it. So one way to do this is say, 100 credit unions do this, it makes sense, there's a supervisor who understands this, so we're going to limit it to that. And cabinet, rather than bring it in and allow everyone to do this and bring all those enforcement issues to the CFPB and the state regulators.
So I also think, again, with the depository institutions, that they have the opportunity to do the underwriting based on what's already in their systems. Inherently, it should be a good deal less expensive for them to do it. And there are also alternatives like the revolving loan, the product that KeyBank has made available as part of its KeyBank Plus program. That is, that is an alternative to the classic small dollar loan for people in the income group we're talking about who are part of that special program. So I think this raises the issue of whether there are things that the CFPB can do in this rule that provide incentives to additional depositories to do the kind of work that Key's been doing, rather than essentially leave the field to folks who have to start underwriting from scratch.
Great. I'm conscious of time, but maybe we have time for one more question. Is that fair game? Good. So we did want to talk a little bit about and ask about the payment collection practices components of the outline. As Kelly described it, there's a notice requirement, and there's also a limitation on the number of presentments that get returned that a lender can submit to the payment system for ACHs and other electronic payments. So I think a starting point is based on feedback that we've heard. Many lenders do provide notices today in advance of when they're, at least they say they do, when the payment is due, just so the consumers are aware of it and can make sure that they have money in their account. Should we be requiring this? Or are there only certain circumstances where we should be requiring it that would make sense in the rule?
I'll go again. So again, to give some context, our loans are 3-year, larger dollar, and sub 36%. But I would say a few things on this. One is I wouldn't do anything to overly discourage the ability to have this practice in place, because I actually think it's a big consumer benefit, and I think consumers want it. You know, when consumers apply, and we have a very small data set, it's a short period of time we've been in market, but we give our borrowers an option. You know, they can go through a ACH debit, pay us by check, or pay near me, which is hundreds or thousands of locations across the U.S. in cash. And every single one to date has decided they want ACH debit. I think that's just the way we live our life, and it makes life easy. Again, it's a short period of time. We do give notice, and we do it today through email, and soon we'll be doing it through text messages, and it's 3 days in advance. And in 2 cases, we had customers call us up and say, "Thank you, I don't have the money. Can I delay my payment?" And in both cases, we said, absolutely. You know, I mean, because that's exactly how we want this process to work. So I'd say from a lender perspective, this has been very positive for us, from the borrower perspective as well, and I think that would apply across the board. In terms of requiring it, the only thing I would say is it only works really well if it's text or email, somewhat of an electronic relevancy. And I don't know, but there's going to be people who fall out of those buckets, and that's just not going to work for them for whatever case. I don't have a use case right now, so I don't know if you can make it 100% requirement. Direct mail clearly will not work in this case. But.
And Steve, have you had some borrowers tell you, "Stop sending me these notices"? That is something that we've heard.
It's too early right now. It's an easy thing to ignore. If I'm the, so I'll put myself in the customer's shoe. I can get notices like this from banks. I can opt into them or not, opt out of them as I want. That's a nice piece. If they came to me, I would not be super discouraged. I would just ignore it. So I don't think that's a big issue, frankly.
I would say that consumers get upset when they get notices from organizations they don't really have a relationship with. But when it's your bank that, you have a loan, it's like an agreement, yes, you and I have a relationship. And that's why I don't think we mind getting those. Actually, I love text notices. They're the ones that I actually pay attention to in an immediate way. Whereas my email is something that you just kind of like go, "Oh, I'll get to it when I get to it." But the text messaging, I love the text messagings that I get from my bank.
I agree with what Steve said about the kind of the channel or modality. Moving to mobile, I think the pace at which we're moving to mobile being the consumer's first preferred method is so rapid and is so valuable. We don't want to get so specific that we necessarily exclude the choice on the part of the institution. They all have different technologies, as we know. And we're moving from text, and then app-based capabilities are growing so fast. But I think one thing that's particularly important is that we preserve the institution's opportunity to take advantage of their best capabilities. In the case of some community banks and credit unions, they're particularly hampered by legacy technology. But also for consumers, because of this noise factor, where I believe the majority of consumers will see a benefit, but there are some consumers who could be harmed by this noise factor that goes on. And so we need to make sure we're not assuming this is a benefit to all consumers and make it easy for consumers to opt out if they choose to.
I just want to point out, I mean, whenever you get to issues of collection, and in the proposed rule says that if you get to a point where you've attempted 2 times, and then the 3rd time you're going to need consent, you know, now you got a barrier going up. So encourage, you know, when you get to that point, that you have the ability to communicate. I mean, you're going to write rules very soon where you might not be able to text and email when it comes to a collection process. So there's a lot of, you know, arguments either way. So whatever you can do when you get to that point where the loan goes bad, that there's the ability both of the consumer to contact the bank and the bank to contact the consumer in a way that is agreeable to both parties, and don't foreclose that opportunity.
Thanks. Just to follow up on that real quickly, that's a really helpful comment. We definitely are thinking about what would that reauthorization process look like and how to make that communication work effectively, and really have a good flow of information so the consumer is understanding what's happening, is in control of the process, and and able to make good decisions. So we are thinking about that. We are thinking also about disclosures more broadly and how to inform the consumer about this and other issues in the rulemaking. That's been somewhat of a second stage process because it's important to figure out what we're doing and then build the disclosures to you know, build off that framework. But that is absolutely something we're thinking about. We do think it's a very important part of the process and really look forward to getting more feedback about how to make that effective.
I think more, Betty?
Just follow up on that. If you're giving notice by text, I would encourage you to, and I know debt collection rules are different, but once you send, I guess the only compromise I would ever agree to is you could send one collection notice via text, and I have real issues with that, but if I have to compromise, and you know, all these systems now have the ability to write stop, and if you say stop and they continue to send you debt collection notices via text, that you have some huge violation that you have now, that the person, because the same thing that's happening on phone calls right now with people constantly calling is what's going to happen on text. And, you know, as we keep hearing mobile is the way people are going, you're going to force people to keep changing numbers, which is just going to add to their cost because they're eventually going to not want those texts. It's not going to encourage them to get in touch. It's not going to encourage them. It's just going to create more hibernation when their phone is filled with overload of text from financial institutions.
Just one comment in regard to our experience with payments. I think I certainly advocate for notice, anything that can equip the consumer to be more informed and prepared to deal with the circumstances, the consequences of being in a payday loan situation. I looked at our all of our charge-off accounts, negative balances in 2014, and a quarter of them were experienced payday loan drafts after the loan had already been charged off. And so I think more important than notice is just, again, what you're proposing in terms of limiting the charges, the ability to collect from a consumer's account after after 2 consecutive attempts at fail. I think that's very important. I think about both the cost of my institution and also the predicament it puts the consumer in terms of their ability to get another deposit account after it's been charged off.
Great.
Corey, thank you. I think what I'd like to do is ask the CAB to, as we wrap this up, and beyond the questions, are there general comments that you would like to make about the payday rule before we transition? Don?
Yeah, I would, and I think this kind of comes a little bit from my state experience. You know, the way that both the short-term loan as well as the longer-term loan proposals or outlines are written kind of allow lenders to adopt one set of requirements, so either the debt trap prevention or the debt trap protection, and without making a direct comment on kind of the content of those particular ones. You know, the one thing that we always said at the state level was, especially for this industry, which is very adaptive, belt and suspenders is really important. And so I kind of see the prevention and the protection kind of being the belt and suspenders that actually make both of these things work. And so my one comment would be that there's at least a consideration of some combination of both of these requirements as opposed to either or.
Ellen?
Yeah, I realize that there's been an incredible amount of work that's gone into this proposal and will continue to go into it. I really would strongly urge the Bureau to move as fast as it can on overdraft, however, because, you know, this is like a balloon that you squeeze. And the alternative products will come to the fore, whereas if we can, if we can have consistent rules that deal with the large majority of the alternative products, at the very least, what you should get is some innovation that pushes the consumer benefit in the direction you want it to go. If overdraft is sitting out there unregulated while this is regulated, it's not going to go there.
I just, excuse me, I would agree with Ellen's statement. I think that when you look at the history of regulation in the states and federally, when they don't address the need, generally it is like squishing a balloon. The demand just goes to a different supplier when you squeeze one group of suppliers. And I think that creating a level playing field is ultimately in the best interest of the consumer.
I just want to say real quick, I know I'm always a broken record on innovation, but I think everyone interested in this issue should keep their eye on the unbelievable flowering of innovation that is going toward this area. People are working on insurance products, for example, to help people insure themselves against downturns in their lives, and lots of new kinds of income and expense smoothing tools. So I just think it's really important to look to this high-tech marketplace offering a lot of alternatives.
What else then? I will just want to thank Kelly, Corey, Director Cordray for all the work that's gone into this extremely important and complex issue, and thank my colleagues on the CAB for their comments. We appreciate the opportunity to provide input on this topic. Thank you. And Sixta.
Thank you, Bill, Kelly, and Corey for leading such an interesting conversation. We're not quite done yet. An important part of how the Bureau helps consumer finance markets work across the U.S. is to hear directly from consumers, from industry, from our state and local partners, and from community advocates. And one of the ways that the Bureau gathers public feedback is through public events such as these. We have held field hearings, town halls, CAB meetings, and other public events in places like Indianapolis, Minneapolis, Birmingham, Alabama, Sioux Falls, South Dakota, Durham, North Carolina, Detroit, St. Louis, Missouri, Atlanta, Des Moines, Iowa, Miami, Los Angeles, Itta-Bena, Mississippi, Phoenix, Nashville, New Orleans, Oklahoma City, Reno, Nevada, El Paso, Texas, Newark, New Jersey, Richmond, Milwaukee, Wisconsin, and now we can add Omaha, Nebraska to that list, among many others. At these events, we not only hear from experts in the field, we invite the public to participate. Before I open the floor for public comments, I want to remind folks that there are several other ways to communicate your observations, concerns, or complaints to the CFPB. You can file a consumer complaint with the CFPB through our website at consumerfinance.gov. Our website will walk you through the process for filing a consumer complaint about a financial product or service. The CFPB takes complaints about mortgages, car loans or leases, small dollar loans, student loans, other consumer loans. We take complaints about credit cards, prepaid cards, credit reporting, debt collection, money transfers, bank accounts and services, and other financial products. If you don't have a specific complaint but would like to share your story with us, we have a feature on our website called Tell Us Your Story, where you can tell us your story, good or bad, about your experience with consumer financial products or services. Your story will help inform the work that we do to protect consumers and create a fair marketplace. We also have another feature called Ask CFPB, where you can find answers to over 1,000 frequently asked questions about consumer financial issues, as well as additional resources. I encourage you to visit consumerfinance.gov to learn more about the resources and tools the Bureau has developed to help consumers make the best decisions for themselves and for their family. Now it's time to hear from public participants here today. A number of you have signed up to share comments and observations about today's discussion. The public comment portion of the field hearing is also an important opportunity for the CFPB to hear about what's happening in consumer finance markets in your community. Each person who signed up to provide testimony will have about 2 minutes to do so, and what we hear from you is invaluable. We want to hear from as many of you as possible, so I encourage you to please observe the 2-minute limit so that as many folks as signed up to share their observations have the opportunity to do so. Our first member of the public is Mr. Jesse Johnson. Someone will bring you a mic. Thank you, Crystal.
Are we good? Thank you, Director Cordray and the CAB. I appreciate this public forum and the opportunity to make a comment. You can probably tell by the fact that I'm not wearing slacks that I'm not an attorney or a lobbyist. I'm a small loan operator. I have less than 10 locations. I can't discuss much about the payday side because we're not in that business. We typically offer loans to, we do loans to consumers, but generally our target customer is what I would call a micro entrepreneur. We do a lot of business with small guys. They might be a sub, they have a work truck, vehicle that they've purchased and paid for outright, and they come to us to typically purchase raw materials or fill a cash flow need in their business. We've all kind of fallen into the same bucket here, and I know that the CFPB is a data-driven organization. There's been a lot of research on the payday side. Unfortunately, I haven't seen a lot of research on the other segments of this industry, the small loan industry, especially in regards to what we're doing, which I understand is a bit of a niche, but in some ways it parallels title lending. The only thing I remember from the CFPB was Paige Mishkin from Vanderbilt did a study, and actually there was a lot of good information in that study, and I think in the end it was generally supportive, and she was a CFPB committee member. I appreciate the comments regarding competition. I have maintained for a long time that really is the answer. In the marketplaces that we participate, our company, although we're small, has driven down the average marketplace pricing by 50%. So the competitors that we were initially working with have had to respond to us. I think that's the most effective solution overall. Regarding the ability to repay, I'm concerned. I do see some understanding on the panel, or I'm reading between the lines. But we have a lot of customers who don't have a bank account. They don't have the ability to prove their income like a traditional bank may require. I'm a former banker. I came into this world and we identified a need and we've created a pretty awesome niche that's been effective. But I can tell you, I was shocked coming out of the banking world at what a large community of folks are unbanked, underbanked, but are not on the radar. So these rules are being built around data that is on the radar. You need to get out into these communities and understand. I know you have people here that understand the issue. Laura, tú entiendes. I understand, okay?
Thank you, Mr. Johnson.
Okay.
Denise Parker.
Hi, I'm Denise Parker. I'm with Creighton's Financial Hope Collaborative, and we do financial education for low-income families. So we see a lot of these struggles. Payday lending became so popular because the individuals who use them cannot qualify through a regular underwriting process. So as you speak of underwriting, I didn't hear much spoken about them being more lenient underwriting guidelines. And I do believe that you're going to have a more difficult time with the expenses rather than the income. Verifying income is going to be a little bit easier task than verifying expenses. And that's where I see a lot of the difficulty. Some of the expenses may be not even on paper. Some of the expenses are, my 26-year-old son had a respiratory problem, and so I had to give him some money. I had to help my daughter out here. I had to pay for that. It's managing their income. Financial education helps with that. I see a lot of good trends here, but I'm concerned that you're not really serving the population who's using the payday lending. As Laura stated, most of the people who use payday lenders cannot qualify through regular underwriting guidelines and cannot qualify with a bank or a credit union. So then we'd still have that need, and although maybe the payday lenders then are regulated to go through the regular underwriting processes, that need may create some other form of payday lending out there that we haven't discovered yet, or hasn't been identified, or hasn't been even thought of yet. But there's that need and there's that income source for somebody who wants to take advantage of the low-income people who can't qualify under underwriting guidelines. Thank you.
Thank you, Ms. Parker. Christopher Pickett.
Can you hear me? I want to welcome you to the Silicon Prairie. It's not only in California that you find innovative fintech companies. I'm going to echo a lot of the comments that you heard today, and there are two short points that I'd like to make. The first is to please be careful when you're finalizing the rule. Rote formula and strict parameters do not achieve your stated long-term goals, do not allow for delivery channel innovation, and do not promote financial health among underbanked and unbanked populations. It's been proven over time that self-policing best practices in the industry, frameworks and open architecture requirements, which address legitimate consumer protection needs, are the best methods of achieving innovation and increasing credit options to millions of Americans, many of them here in the Midwest. The second is to please not make us an increasing target for data thieves and breaches. Even the government and the largest, most sophisticated corporations struggle with this issue. Consider that a rule requiring lenders to collect physical documents from consumers and convert them to electronic copies for long-term data retention is a serious step backwards of limited value in making our credit decisions and puts everyone at risk for loss through breaches. Rather, instead allow us to use modern underwriting techniques focused on accessing credit-associated data points from third-party data reporting services and making our credit decisions. Again, here in the high-tech Midwest, we know how to underwrite loans, several $100s, so that we are repaid and our customers get the short-term credit they need. Please give us a framework and the freedom to innovate and serve those needs. Thank you for the opportunity to speak.
Thank you, Mr. Pickett. Mabel Alarcón Craven.
Good morning, and thank you for giving me the opportunity. I work with Catholic Charities Microbusiness Program, and 99% of our clients are low-income working families. And I want to say thank you to the CFPB for this wonderful task that they are doing. I witnessed how many of our clients have benefit from your services through getting responses to complaints that they have filed with the CFPB. What I want to say is I think the small loans, short-term loans, are a need in our community in Omaha. What I am not sure is if the traditional lending institutions are going to be the ones who can provide the solution to our problem. Many of these families don't have the capacity or ability to face any emergency situations, and that's the reason they have to go to the payday loans and pawn shops and other similar kind of loans that we know once they people enroll in the payday loan cycle, a few months later they are worse than they were at the beginning. So I want to leave you with the question or the thinking that we need to evaluate alternatives. I don't know where they are, maybe the non-traditional lending institutions, giving them incentives but regulations so they cannot abuse, but to find an alternative and support alternatives for this kind of loans. Thank you.
Thank you, Ms. Alarcon Craven. Rich Horner.
Can you hear me? Thanks for coming to Omaha. I'm a native of Omaha and work for a company that operates 13 payday stores throughout the state of Nebraska. So very interested in the proposed rules, and I've heard some great comments today. You know, the concern that I've got as an operator of a payday loan business is I'm hearing kind of some kind of a wide range of comments that describe the typical payday loan customer. And in the experience that I've had in my stores is that there really is no typical payday loan customer. I mean, the people that come into our stores range from 20-somethings to 60-somethings, from modest income to six-figure income. The range of reasons that they need a short-term loan is all across the board. They make an educated and conscious decision to come into our stores because it's a quick and easy way to get. Our average loan is about $325. I mean, we're not talking about thousands of dollars and a spiraling cycle of debt. Nebraska is a state that has regulated the payday industry, is one of 32 states that has statutes and is heavily regulated, and we have a good relationship with our director of banking and the regulatory agencies within our state. So I feel that Nebraska, you know, is not an out of control state that is, you know, preying on borrowers. So the proposed rules that I see, I'm kind of a data guy myself, and the big disconnect that I see that concerns me the most is in Director Cordroy's opening comments. He talked about the CFPB's complaints that they received, and I believe he threw out that over a year and a half, roughly 24,000 complaints had been received, which represented about 15% of the total complaints received by the CFPB. In the proposed rules outlined in the 57-page report issued earlier this year, the CFPB concluded, I believe, based on either of the two types of controls, that such rules would reduce the small dollar lending anywhere from 60 to 75%. And so I see a huge disconnect, and a reason for concern is that if there's a 15% of the complaints are related to the industry, the CFPB is proposing rules that would reduce the industry by 2/3 to 3/4. And it seems extreme, and you know, I would hope that they would take a hard look at that. Thank you.
Thank you for the comments, and thank you for taking the opportunity to review the materials that are available to the public. Greatly appreciate the thought that you bring to them. Michaela Harper.
Hi there. Thank you for coming to Omaha. My name is Michaela Harper, and I work for Credit Advisors Foundation. We do credit counseling in 37 states from our offices here. And we are it's pretty rare for credit counseling organizations to take on payday lenders, but we've done so for over 10 years. And we've had a lot of experience in this area on how getting people out of the cycle of debt and getting their debts paid off. So in terms of payday lending, I just have a couple points I'd like to make. I think it's really essential to build in a way of tracking and limiting the number of loans. Absolutely important. The most egregious one that I personally helped handle was 18 outstanding at one time, because they just kept rolling and rolling and rolling. And so then you've got someone who's paying $9,000 in fees every other week, and making no forward progress. And granted, most people do 2 or 3 or 4, but still, 1 or 2 is probably the best limit. I get the idea that you want to limit the number of times that you can roll over funds or have consecutive loans, but small lenders are not credit counselors. And so I think you need to build into this that if someone is in that cycle, that they need to, in order to obtain a long-term repayment plan, obtain some kind of credit counseling from a certified counselor, nonprofit, whatever, registered nationally, just a good source who can go in and look at their budget with them and set up a plan. When people come to us and we set up action plans, we build savings into it, not huge savings. We're not talking set aside thousands every month, but that $5, $10, $15, $25 that's going to cover you when you get in the situation where you're $300 or $350 to reduce the need for this type of lending. And I think that's essential. The other thing is, if there could be some requirement that if someone does go into counseling and is trying to work their way out of this problem, that best practices in the industry recognizes that cooperating with counseling is in the best interest of all parties involved. We've had situations where there are some payday lenders that when we send them a notice that someone's entered into counseling, they just accept right away and set up the payment plan, and we get the people out of debt. But we've had them that have accepted the payment plans, cashed the monthly checks while they continued to send ACHs through on their bank account. And so they're continuing to generate NSF fees for the person, or they wait 4 months and they send it through on a payday, thinking that they're going to get the funds, and they'll get the funds, so we'll have someone almost to the point of being totally stabilized on their feet, and that $500 will come out, and then 2 weeks later we'll get a refund check from where they held the money in suspense for the previous 4 months. You know, there has to be some kind of best practices in the industry as far as cooperating with folks that cannot meet the repayment. And the other comment I had, the 2-day notice, that you're going to take funds out of their account. If the idea of that is to enable the consumer to get money into the account, or to take action to get in contact with their lender and say, listen, the money's not going to be there, can we make some alternative plan? Most ACH programs that I'm aware of, you've got to build that file and transmit it to your bank. If you wait until 2 days before the pull date, that order has already gone off to the bank, and the individual may be able to work out a new repayment plan with their lender, but they're still going to incur the insufficient charge at their bank. So maybe even 3 days would be enough to back that up, enough that they could take action that would prevent them from incurring more fees and debt.
Thank you, Ms. Harper. Brian Cheney.
Hi, I'm with a small payday lender here in the state of Nebraska, and just a couple comments that I'd like to make. I think it's essential for you guys to look at what the consumer actually wants. I think you have to take in consideration that there's a need and the consumer is going out for this, but have you actually gone and asked the consumers, hey, what do you guys need? Because I haven't seen that. I haven't seen where you've gone to the consumers of these loans and stated, hey, we're going to make some rule changes. This is what we're proposing, and this is how it's going to impact you. That hasn't been done. And if the consumers know that and how it's going to affect their ability to retain credit, I think they will object to what has been proposed so far. Are there changes that need to be made? Absolutely. But the changes that you're proposing are extreme, and you're essentially eliminating the small business owner. They will be gone. There will be no more mom and pops, single store owners. It's not feasible. You can't lose 70% of your revenue and expect for small business owners to stay in business. That's all my comments. Thank you.
Thank you, Mr. Cheney. The Bureau has had the benefit of numerous Tell Us Your Story filings, thousands, and it's clear to the Bureau that there is a need for small dollar lending. It's something that we're very aware of. Thank you for your comments. Samantha Hoffman. Richard Breyer.
Good morning. My name is Richard Byer. I'm the president for the Nebraska Bankers Association, and on behalf of our 205 members, we want to welcome you to Nebraska and thank you for coming out to hear about what's going on in the greatest part of the country. We also have this little activity going on across the street. We hope you get a chance to take in a college game while you're here.
We have.
Good, we appreciate that. It is something we're very proud of, and it is the greatest show on dirt in America, so we do appreciate that. I do also want to make a couple of other comments. Number one, to Director Cordray on your postponement of the TRID regulations yesterday. Thank you very much for that. Thank you for working with our industry. In terms of the discussion today, I just had a couple of general thoughts. And number one is a lot of conversation about the unbankable. And rather than spending all of our time and energy developing rules to deal with that, maybe our strategy should be focused on how to make those folks bankable, because there's lots of opportunities to do that and to make that happen, and we would be happy to work with you in making that and in taking on that as a strategy. We also want to make sure that we don't, as you suggest, cut back on innovation in the industry. We think there's some real opportunities out there for some neat things to happen going forward, whether you're talking about banks or credit unions or a bunch of other providers. And then finally, as we talk about credit, we try and refer to it as common sense access to credit. We all know when things are in disarray or sort of out here on the fringe and the edge, and we need to be careful with that. So we would encourage you to keep a focus on common sense as you deal through this process. Finally, in terms of what's going on in Nebraska, I do want to share with you one concern that we have that's been a result of some of the CFPB efforts, and that's what's going on in the mortgage sector in our smallest of communities. I know it's not relevant to today's discussions, but what we're seeing as a result of new disclosure and many of the liability issues that are out there, we're seeing many of our small institutions completely get out of the mortgage business. And we have several counties right now in Nebraska that you cannot get a mortgage. And that's difficult to the consumer, it's difficult to the community. And so as we move forward, we'd encourage you to take a look at your board, and I tried to write them all down and do a little Google searching this morning. I think Spartanburg may be the smallest community represented on this group. Most of our communities in Nebraska average between 500 and 1,000 people, so maybe it would be helpful from your perspective to also include some folks that are being impacted in those smallest of communities, so they can share with you things like this mortgage issue and the challenge that's going on in America's heartland. Thank you.
Thank you, Mr. Beyer. We agree that the Bureau benefits greatly from listening to folks that live in smaller communities throughout the U.S. We have a Community Bank Advisory Council, which is specifically designed to ensure that we hear from the smallest of the smallest financial institutions. And they helped us ensure that as we were promulgating our mortgage rules, we tried to effectuate a balance between preserving access to credit and ensuring consumer protections. And as a consequence of that very critical feedback we got from that advisory council, we created an exemption for small community banks, small credit unions, and small financial institutions. And we created other exemptions for the smaller institutions because we think they're an important fabric of the financial system in the U.S. So I appreciate very much your comments. They're not at all irrelevant. Thank you. Elizabeth Christensen.
Thank you. Thank you for having the opportunity to speak. My husband and I are small business owners. We own one store in the state of Nebraska. So you mentioned an exemption for small businesses. I'm wondering if you would consider exemptions for small businesses, because really as we look at these rules, it would completely eliminate our business in the state of Nebraska. In the state of Nebraska, I want to make sure that everybody understands what is payday lending in the state of Nebraska. The loans, the most that can be given is a $500 loan. There's only short-term loans. There are no car title loans. There are no installment loans. There's no provision in any of the laws for that in the state of Nebraska. The account cannot be repeatedly ACH'd in the state of Nebraska. You cannot go into the account in the state of Nebraska and do that. It's a very highly regulated product by the Department of Banking. We met as an association yesterday with the Department of Banking. The Department of Banking told us that they virtually have zero complaints from payday lender consumers in the state of Nebraska. You mentioned that there are 5,600 complaints. What is that as a percentage of your total complaints in overall for I have friends, I have family members who have many complaints about mortgages, they've lost their homes to things. What is that as a percentage of the total complaints? So why is this focused on that particular? I also wanted to speak about the provision for us as store owners. There are many times when I'm in a store that I will give a loan to somebody for $100, knowing full well it cannot be repaid. And I will not give that to collections. I know it because there's a need, and I see the need in someone's eyes, and I'm making a decision. Sometimes I have to talk to my employees about, I've made a decision, and that's what we're going to do today. There are provisions in the law for collections. If a debt goes bad, you have a decision then to then go into the collections. It's very highly regulated with the Fair Debt Collection Practices Act. Someone mentioned a retired individual of SSI or Social Security. If an individual is on disability or retired, you cannot collect that individual. So by the very nature of those existing laws, it does protect those individuals. Someone else mentioned an individual with a loan of $2,100 or more. My husband and I have been married for 32 years. We have 4 children. My daughter has loans exceeding her college education, her car payment. That's a very common. We had loans many years that exceeded our income level. That is not a new thing in America, that the amount of debt you have exceeds the income that you do have. You're working towards something better. When I was 18 years old, newly married, I went in, before we had any of these, I went in to try to get a tooth worked on because I was in excruciating pain. And the dentist told me unless I had $500, I could not get my tooth fixed. I went for 3 months in excruciating pain to try to get money to have that fixed. There was no alternative. There was no parents to go to. There were not services. There was no bank that was going to give me any amount of money to do that. The alternatives, consumers make choices, and they make choices that are right for them given the products that exist. So I'd really encourage you to really think about this and how it will affect a small business owner.
Thank you, Ms. Christensen. Michael Debenham.
First of all, let me say thank you for these forums, for the opportunity for us to come and speak. I am a small lender, a mom and pop lender with less than 10 stores. I work the tests and I know my customers' names. Majority, we do title lending. And I will say this, majority of our customers do not have bank accounts. They use cash in their process. This represents a massive part of our society. And it's fundamentally different than what a payday loan is. And payday loans certainly have their place, but we are fundamentally a different product and they're used differently. We're oftentimes giving loans for several $100s and on average less than $1,000 for cars that are worth generally about $1,000. And if that car were to, if they were to drive off in that car, the engine were to seize or the transmission were to drop off that car, they turn it over and that debt is satisfied. There is no deficiencies that we go after in this process legally or otherwise. And so this is a fundamentally different product for a different group of people that do not have bank accounts. And you know, that's fine. We have to be able to absorb those losses, the fact that many of these cars can become broken and that we have to absorb those losses within our process. You know, regardless of what we decide here today, the fundamental need for emergency short-term lending is not going to go away. So don't take this multi-billion-dollar industry off the grid to illegal sources. Instead, let us compete with each other. Let us compete in a fair way. And give us a level playing field. Create concrete processes by which by which we can compete with each other. If this is left undefined, the most honest of us will go out of business because we'll take the most conservative approach. So let us compete with each other in a fair way, both depository and non-depository lenders. And I just ask you to take a thoughtful approach to title lending as we represent a very different marketplace as we represent the unbanked, those who do not have bank accounts. Thank you.
Thank you, Mr. Debenham. Curtis Christensen.
Hello, thank you. My wife already stole most of my thunder, so I'll make it fairly brief here. Just a couple points that I wrote down here. You know, really, this is first of all, to repeat, we have one store as a payday lender. It's a demand-driven product. A couple people have touched on that already. To ask the consumers out there, you know, what they're looking for. If you make it so tough, everything's going to get closed down. There's not going to be a product out there for them. Another comment was made on relationships. Our employees frequently get Christmas gifts from our customers. There's a strong relationship built, and they know each other's families. It becomes a personal relationship. Another comment on a gentleman up in front mentioned about an individual with a vehicle loan. His vehicle broke down, he went in to get a loan. What was he supposed to do without it? His vehicle broke down, he needed money. He may have been going to work that day. His vehicle breaks down, he doesn't get to work, he loses his job. Now we got another individual on government payroll. This product gives that guy an opportunity, that person an opportunity to get that vehicle fixed, maintain his job, and contribute to society and pay that loan back. Another comment was on unbanked and underbanked. I believe, if I recall, it's something like 30% of our population. Most of those choose to do so. And again, these payday loans, et cetera, fill a need for those people who choose to be in that category. So do debit cards. And the last one is to reiterate a need for an exemption for small business owners like that's out there in the mortgage industry. Thank you.
Thank you, Mr. Christensen. Julie Kalkowski.
Good morning, and I don't envy you your task. It's a Herculean task, but there's got to be some kind of balance. I work with low-income single mothers, and what we saw, we had one woman come in. She was rolling first 13 payday loans, then 14 every other Friday. She had to take off 4 hours early so she could go to payday lender to keep rolling her stuff over. Now, we do have a law in Nebraska. We do not enforce the law in Nebraska. And that's where that goes to, I think, Ellen's point. We need a national directory so we can limit to one payday loan per person, because people get into this downward spiral of debt they can never get out. The other thing I want to do is, it's self-evident, a huge, huge market. How do we incentivize banks and credit unions to get into this field? Is there a way that they can make money by meeting a community need? And the other thing is, I think no one has addressed this, but the money that goes to the excessive fees and outrageous interest rates that a lot of our consumers, especially low-income single women, are paying, what would that happen to our local economy if we could take all that money and put it into our local businesses? We had an economist do a payday lending survey, what is going on in Nebraska and actually in Douglas County, and he found that if we had a credit union alternative payday lending in Douglas County, it would generate $24 million in business activity. So I think you have a tremendous opportunity to do a lot of good. Again, I don't envy your task. You've got a lot of different things to weigh, but it is a huge, huge problem. People do need access to affordable credit, but we can't continue the way it's been. It's just harming too many families and putting them onto a road to disaster. Thank you.
Thank you, Ms. Kalkowski. That concludes the public comments. So at this point, I want to thank folks who provided thoughtful comments. They're very helpful to us. And I'll turn the public meeting back over to Chair Bill Bynum.
And we'll resume it too. Thank you all. I want to echo Zix's comments. We appreciate hearing from you, and we look forward to hearing, to visiting with you more this afternoon. This is the only opportunity for public comment, but we will now be breaking for lunch, and we will resume this afternoon at 2:30. So hopefully we'll see you then. Thank you.